I don't think Janet Yellen is sounding hawkish at all. I think the comment about the 6 months, maybe that's something she ad-libbed. But, you know, I don't even think it matters what the time period is between the end of QE and the first rate hike, because I don't believe the Fed is going to end QE. So it's a moot point. You know, Janet Yellen has said that it's all data dependent. And she's pretending right now that the bad economic numbers are the result of the weather. It's got nothing to do with the weather. It's the U.S. economy. That's the problem. And as we continue to get weaker data in the springtime, I think Janet Yellen is going to be singing a different tune, and she's going to be slowing down the taper, if not reversing it completely.
And Peter, you say that, she could use perfect excuses like, where equity prices are heading and also the real estate market. But, I mean, have they used those indicators before in terms of determining Fed policy?
Well, Fed policy is the reason the market rallied. It's the reason that the real estate market rallied. If the Fed takes away those monetary props, the markets will implode and we'll be right back in recession. I think the Fed has to know this. And so all the talk about removing those supports, it's just talk. It's not going to happen. You know, they took the goalpost off the field today about the unemployment rate. Initially, the Fed said, well, if unemployment gets down to 6.5%, we're going to tighten. And that was because unemployment was a lot higher than 6.5%. Now that it's actually in that vicinity, they need to take away the goalpost because they cannot lower rates or raise rates without destroying the phony recovery that they helped create.
Okay, so you're saying that they're going to try and find any excuse possible to keep those rates lower for longer. Does that mean that investors shouldn't count out bonds in their portfolios?
Well, you know, eventually bonds have to collapse in real terms because the only way the Fed can artificially suppress interest rates is to keep printing money and buying up bonds. But ultimately, the dollar has to implode as a result of all that money printing, and that's what U.S. Treasuries are. They're IOU dollars. And so if the dollar is going to collapse because the Fed has to print so many to keep interest rates artificially depressed, you're going to lose money in U.S. Treasuries. So there's no point in owning them.
Okay, so where do you put your money? Is it all in equities? How far are you spread into cash at the moment?
Well, I have very little cash. I mean, we're investing all around the world. First of all, gold sold off today. Gold stocks have been headed down the last few days. I think that's a good place to look. But I think you have to look at some of the other economies. Look, New Zealand just raised interest rates. They're in much better shape. The New Zealand dollar has been breaking out, so you can look at that economy. But there are a lot of other markets where the fundamentals are much better than the United States, and that's where you want to invest. You want to own equities. You want to collect dividends from stocks that are not hyped up and overvalued. And you really have to be leery of the currencies that are being printed, like the dollar, like the euro, like the yen. These central banks are creating a lot of problems. They're not solving any.